Stocks and bonds, they play a key role in virtually every investor's portfolio. While most investors expect these traditional assets to have a fairly high long-term rate of return, the volatility of the markets often makes them risky in the short to medium term. But today, there is an emerging asset class that continues to surpass the value of stocks and even bonds. Commodities are tangible resources such as food, agriculture products, gas and oil, as well as precious metals. Many financial advisors recommend investing in this alternative asset to create a diversified and well-balanced portfolio.
Investing in commodities is a good idea because commodity prices can sometimes trade very high or very low. And at these extreme levels, significant investment opportunities arise. But prices don't stay at these extremes for very long. They ultimately revert to some kind of a historically normal level, and we call that level the equilibrium level. History has shown that if you were to take the past 90 years of prices for these inflation-adjusted and trend-adjusted commodities, they always revert to their historical mean. This is simply a function of market forces at work.
According to DiTommasso, the reversion to the mean approach is one of the most powerful tools in investment markets. He says this disciplined value investing style requires a longer-term focus and patience.
Now, this chart gives you an example of what we mean by the reversion to the mean approach. As a commodity becomes significantly mispriced, we will establish a position. And if it gets further mispriced, we're prepared to add to it until at some point it becomes what we would call a maximum position. However, we restrict the size of any investment to allow for sufficient diversification in the portfolio and also to minimize the risk associated with that investment. Actually, we have a good example of a negative correlation occurred in 2008. At that time, both commodities and stocks got extremely highly priced. Recognizing that several commodities were beyond what we would consider normal price, we took short positions in those. And by the end of the year, as you might recall, in 2008, commodities and stocks both crashed. And we closed out all of our short positions in commodities, every single one of them at a profit. By the end of the year, we showed the fund, our flagship fund, the Equilibrium Fund, had produced a return of 27%. The S&P 500 index, on the other hand, was down 38%.
Another key to investing in commodities is the advantage of option contracts over futures contracts.
Firstly, options allow us to measure precisely the actual dollar amount at risk in owning those options. Secondly, options provide significant leverage. What I mean by that is, if you were to spend $1 to buy an option of wheat, for example, you might have $15 or $20 worth of wheat underlying that as a futures contract. So that if we're wrong and the commodity price moves against us, we'll lose $1. However, on the other hand, if wheat performs as expected, we can make many, many times the dollar return. So the advantage is in owning the options. It really does minimize risk. The main disadvantage of using options in place of futures is that as time passes, time decay has a tendency to erode the value of the options. That's just part of the marketplace, and there's nothing that can be done about it.
Every investment has some form of risk involved, but the use of options allows managers the opportunity to determine precisely the amount of dollar risk in an account at any given time.
Risk is controlled by having the primary investment in the portfolios as treasury bills. Options actually comprise a very small part of the total portfolio, and we tend to buy very long-dated options. If the options work out, we do well. If the options encounter adverse markets, there's sufficient cash to replace those options to buy more and more time until eventually prices do revert to their norms, and we liquidate.
One of Canada's leading investment management firms based in Victoria, British Columbia, the DiTommasso Group is committed to bringing commodity exposure to individual and institutional investors using a conservative long-term approach. The organization attributes much of its success to operating on 4 guiding principles.
We have 4 guiding principles. The first one is that the market will surprise. Now that looks pretty obvious, but what we see in the marketplace from time to time are unusual events, and quite often those events create opportunities. Secondly, we trust facts, not opinions. What we have found is that by going by historical data, as opposed to conjecture, our system works. Thirdly, we control risk. The objective here is to minimize the downside, and we let the returns take care of themselves. Finally, our fourth rule is be patient. From time to time, we encounter adverse markets, and the secret to what we do is to be able to withstand those and bounce back and carry on, move forward, and achieve your returns.
For more than 20 years, the DiTommasso Group has been managing commodity pools for high net worth individuals and institutions, including a major Canadian bank. It manages a highly recognized commodity pooled fund called the Equilibrium Fund.
Firstly, we view commodities as long-term investments. Our value approach recognizes that reversion to the mean is a valid and powerful tool, and we exploit it. Secondly, our use of options as the primary investment vehicle allows us to limit the amount of risk in a portfolio, and that's our edge. It's clear commodity prices will fluctuate, and as they fluctuate significantly, we will identify opportunities and exploit them as we have in the past.
To find out more about the DiTommasso Group Incorporated, call 250-744-1650 or visit DiTommassogroup.com. Value investing in commodities since 1991.